It's Equity News on Equity Access, your cross-section of the stock markets and of developments in the Zimbabwean economy. A beautiful evening it is to you. Thank you for joining us as we brought. Let's get on to business. The Energy Regulatory Authority, Zera, has released new fuel prices following the removal of fuel subsidies by the Reserve Bank of Zimbabwe yesterday afternoon. New petrol pump price will now be 4.95 RTGS dollars per litre, while for diesel it's 4.85 RTGS dollars per litre. This is a 45% increase on the government set prices in January of 2019. In the same vein, government has reduced duty on fuel from 2.3 RTGS dollars to 1.15 for petrol. For diesel, the duty adjustment is from 2.05 RTGS dollars to 90 cents. Treasury says this adjustment has been factored into the new fuel prices. Permanent Secretary in the Minister of Finance made a statement. Let's listen.
Our government has reduced the duty on petrol and diesel. As you might be aware, the previous duties were $2.30 for petrol and $2.05 for diesel. These duties have now been reduced to 90 cents for diesel and $1.15 for petrol. This has been done in order to ensure that we cushion the public from an increase in the price of fuel.
Just in from government's cabinet briefing, government has commenced disbursement of the Emergency Business Relief Fund for businesses affected by the 14 to 16 January 2019 violent demonstrations. So far, a tranche of $10 million out of the $30 million has been dispersed into the loan fund account. Information Minister Honorable Monica Mutswanga gave the update. Let's have a look.
So far, a tranche of 10 million out of the 30 million earmarked for the program has been dispersed into the loan fund account. The total value of stocks looted and damages to property and equipment belonging to the affected business is about 24 million. And a total of 4.9 million has already been dispersed to replenish the stocks. Currently, the affected provinces are processing requests for equipment and infrastructure, with the disbursements expected to start this week.
The cotton selling season springs to life next week, with the Reserve Bank of Zimbabwe offering 1.95 RTGS dollars per kilogram. And the Reserve Bank of Zimbabwe has announced that for every cotton bale weighing over 200 kilograms, the farmer gets US $10, RTGS 150, as well as the balance paid through mobile money platforms. The delivery of cotton between 200 to 150 kilograms would see a farmer getting $5 US, 150 RTGS dollars, and the rest paid by phone or through the bank account. Now let's get into the stats of how Zimbabwe has performed. These, of course, are initiatives on government's part to try and get Zimbabwe to have cotton as its major forex producer or earner, as was the case in the past. So this would be, of course, the historical perspective of how Zimbabwe has performed over the years, coming right from 1998 to 2018, which is, of course, a 20-year comparative period. Now, this on the top, or should I say the orange line, would be the price of the cotton per ounce vis-a-vis the ZIM output in bales. These, of course, would be in hundreds, in thousands. Now, in 2011, this is where we actually hit our peak at 675,000 bales. And this has been our performance. And as you can see, we hit a low of 53,000 bales in 2015, rebounding in 2017 to significant progress at about 60,000 bales. Then in 2018, that is actually how we've been able to perform. Now, as we make progress comparing Zimbabwe to how other major producers on the continent have actually failed, you look at Mali, you look at Zambia, vis-a-vis Zimbabwe's performance. Now, you look at how the nation of Mali has actually performed in 2003. This is where they actually produced about 1,200 bales in that regard. You look at how Zambia has also performed, comparatively for Zimbabwe, there has been a general decline, whereas for a country like Mali, there has been an increase in their figures, as you can tell from the graph. Same thing can also be said about Zambia. You can see that upward trajectory there, they have of course been affected there due to the prices as of 2015, but ever since they have actually been recording positives in that regard. So that would actually be the historical performance of how the countries have fared in that regard. Then the country's leading manufacturer of conveyor belts, General Beltings Holdings, reported their 2018 financials, and according to the report, revenue for the year closed at $4.7 million, which was in line with 4.75 million achieved in the prior year, as rubber division volumes slumped on foreign currency related challenges. Rubber division volumes at 257 metric tons dropped by 11% from the prior year's 289 tons. Consequently, turnover for the rubber division declined by 17% to $2.3 million against the prior year at $2.7 million. Operating costs scaling 10% from the prior year to $659,000. Now, this would be how General Beltings has performed over the past few years. They have of course been operating in a series of losses. You look at their performance, their revenue there 3.08 to 2014, 2016 3.32, 2018 $4.74 million, a slight dip from how they actually performed in the year 2017. A bit worrying is how their profit position has continued to sail in the red. A series of losses right from 2014, a slight improvement in 2017, but again their net loss position seems to be gaining momentum from 0.19 in 2017 to 0.71 in the year 2018. Moving beyond our borders, Zambian government makes a move to take over Vadenta's Konkola copper mines. This is according to a statement released by the president Edgar Lungu. Now, of note is the fact that there have been raised royalties as well as taxes, which have actually drawn the wedge between government and the Canadian listed company, which is Vedanta. Of note is the fact that Zambia is Africa's second largest producer of copper, second only to the Democratic Republic of Congo. This concludes our news bulletin. Up next is a news review. Please don't go anywhere. Welcome back, viewers. It's now time for news review, and with me is Tinashe Kaduo, an investment analyst with us here at Equity Access. Tinashe, good evening and welcome to the show.
Thank you, Ben. How are you doing today?
Can't want complaints. You don't get better yourself.
I'm very well.
Beautiful. Let's get the ball rolling. Let's just get into the topical, which is the fuel matter that, of course, has made a lot of noise across the board with the fuel prices. A 45% increase from what was stated by government in January of this year. Now, what is your perspective in light of what has actually taken place? Earlier on, we saw Zera issuing a statement that said fuel prices have actually not increased. Then a couple of hours later, they come back to say, look, we've actually increased the price of fuel to 4.95 as well as 4.85 for petrol as well as for diesel, respectively. What is your assessment of that development?
If you look at the policy pronouncements, especially by the energy regulator, which is Zera, and also in light with the ministerial pronunciations, it's something that speaks to sort of unpreparedness in terms of policy formulation. If you look at that, you are seeing a lot of contradictions in terms of those press statements that were issued by Zera. So to the regulator, actually, I think it's something which came maybe as a surprise to Zera. I think maybe Zera wasn't even consulted, by the responsible, authorities, which is actually the Minister of Energy as well as his counterpart in finance. So I think the energy regulator wasn't informed, and it's actually a decision, that came from the top to bottom approach, which is actually a top-bottom approach. But an increase in fuel price, it was inevitable. If you look at what was happening at the interbank market, a subsidy to fuel importers, it was unsustainable given the continued foreign currency shortages. So to continue cushioning them, it was an extra burden to the government at the expense, for your taxpayers who are actually suffering more because of all those increased taxes to support those the fuel market. But liberalization in an economy where production is at its lowest ebb, sometimes it comes with huge risks or at a huge cost, which might even lead to sort of shortages, especially if we are not prepared as a nation in terms of providing sufficient foreign currency to meet the demands of those fuel importers.
So are you saying that we should have kept at the dressed subsidy?
100% liberalization. To me, when you consider what's happening in the economy and the entrenched headwinds, to me I don't think it was the correct intervention. Maybe there are certain commodities, like fuel is actually a key raw material in each and every production process, and even in each and every consumption decision. So to increase the price of fuel, sometimes it comes with other costs attached to it. So I actually expect to see prices of other commodities reacting to increase in fuel price.
Yeah, definitely we're going to see inflation take off because of this particular development, and I think we can also expect fuel to continue on an upward trajectory in terms of the pricing. But I would be of the opinion that it's best that we come to terms with the situation on the ground, rather than the whole dressed up situation where we've got fuel supplied at a rate of 1:1, which we know very well is very much fictitious and is not good for our country. So
but if you look at most of the economies, like Zambia, for instance, over the past years it used to subsidize diesel, because diesel it's used much in the productive sector. So I think maybe for Zimbabwe it's actually a policy I think authorities should look at. You look at what's happening in agriculture, where farmers now, especially the tobacco farmers, are selling all their commodities at lower prices, and they will be now being required to purchase fuel at that escalated cost. I don't see our farmers being motivated enough to go back into the field. So I think as authorities, maybe they should have try maybe to cushion to give more like a cover to certain sectors of the economy which are key to productivity, especially agriculture, because we are actually an agri-based economy. So I think maybe when in the coming season or during this winter cropping season for wheat farmers, maybe the government should try to implement subsidies or to give fuel to your wheat farmers at a favorable price, or maybe even supply that fuel as part of the key inputs.
My question to you would be, is this not enough that government has reduced the duties from 2.30 RTGS to 2.05? Then, of course, for diesel, there is also something similar there.
If you look at what happened in January 2019 when the government increased the price of fuel, the government said, the fuel price hasn't increased. What we have increased is the duty, and that we have increased. So right now, they will be saying, no, we haven't, increased the price of duty because we are reducing the duty that, those fuel importers are paying. So those players in that sector, they are now expected, to lower the prices in light of the reduction in duty of that diesel and petrol. But if you look at prices, how they react, prices are always sticky downwards. When a price has gone up, it's very difficult to see price, adjusting downwards. So this is actually, the government is trying to send, a perception that, we have actually, reduced the duty, so there is no incentive for fuel retailers to increase the price of that fuel. But that's not happening because already we are seeing prices, they've gone up. Now diesel it's being charged at around $4.89 per liter, which is costly considering ZIM standards.
Interesting times ahead. Now you mentioned the word commodity. Let's get into one of those. Cotton selling season coming through next week, and RBZ has offered $1.95 for per kilogram, as well as of course other shifts that have come along with that, where for if you're going to bring in a bale that weighs more than 200 kilograms, you would get $10, 150 RTS plus payment in your bank account or on your mobile money platform. What do you think about the pricing that RBZ has offered to the farmers?
The government is trying, to incentivize cotton farmers to increase production. But if you look at what happened in cotton, it's a sad story indeed. Cotton used to be one of the largest contributors to our foreign currency earning capacity. If you look at 1998, along this graph, we were up there producing around 600. Is this what about 600,000 bales?
Yes.
Then production peaked 2011 to 700,000. But now, of lately, it has dropped to below 200,000. But if you look at the issues that affected cotton production, it was much to do with side marketing, and also what I may say, heavy-handedness by the government in terms of its intervention in the cotton sector.
There was definitely too much interference from government.
Yes. So if you look at it, even the tobacco farmers, they are also complaining that government intervention is also now a killing incentive to produce tobacco as well. But if you look at cotton, now the government is now accepting that it made past mistakes, and it wants now to try to incentivize farmers to take up production of this. We used to call it white gold, because it used to earn us a lot of foreign currency. So it's now trying to promote that. But most of the farmers who used to produce cotton, they had substituted or moved away from cotton to other, cash crops. So I don't see, farmers trying to respond, in a shorter period of time, trying to produce more and more cotton. I think what we might see is those small communal farmers, which are your households, normally in those regions that doesn't receive enough rainfalls, like the Gokwe and the lower parts of Chipinge. Maybe those are the farmers that will continue to undertake cotton production, and they will be relying much on government subsidies, on the presidential input scheme and other government interventions. The price itself, yes, it's lucrative because the government is also offering a certain payment in US dollars. Like if you deliver between 155 kgs to 199, you'll be paid at 10 US dollars in real US dollars. Then the balance will be paid in cash, and the other portion will be paid via eco-cash. I think that might try to cushion those farmers. But most of those farmers that undertake cotton, I think when I did my last survey, I didn't see a large scale a farmer who was actually undertaking cotton. It's now basically your small individuals, like your single families, your poor or your marginalized families. So those are the people that don't have the scale to produce much cotton. And if you look, when you are comparing
our performance to how other players have actually played, you look at Mali. I mean, Mali, they've actually performed quite well. There was, of course, a dip in 2007. to 2010, but ever since it's been an upward trajectory. And then you look at the price, the price of the cotton, they now starting to actually gain a bit of ground there. Could perhaps the positive trend with regards to the price serve as an incentive to our local farmers?
Yes, price might also serve as an incentive, but like what I said is that cotton production now is now being concentrated in those your few, like your individual households. But if you look at what's actually happened in terms of our cotton production, the other thing is our limited research and development. Some of these countries, they invested much in research and development, and they also introduced like your hybrid, your genetically modified.
I read about that. I read about that in our press just a few days back. Was it last week, where there's actually been that development of there being such a facility in Zimbabwe.
Yes. But if you look at in terms of our technology or in terms of our research and development in that area, we're lagging behind. So maybe when you are seeing that production of money up there, maybe it's now the seed that we are now trying, to introduce to our farmers this year. And in agriculture, there is always a learning curve. Okay. And when you want to understand your new varieties, sometimes it takes time. First year or second year, you will be still learning. And maybe after third or fourth year, that's when you see, productivity ramping upwards. But it's actually, a sad story, especially in the cotton subsector. And I think the government should continue, promoting such interventions and such policies that might try to motivate farmers to undertake cotton production.
Fair enough. Now, let's talk about General Beltings. They released their 2018 financials, and now we're getting to the Tinsewinsi Zera. And this is how they've performed. You look at their profit position, they've been in the losses. I mean, it's become the order of the day. What is your comment on their performance?
I thought last year they made a profit of 600,000. Didn't they? Maybe they revised it downwards in 2017. I think they made about 600,000. But anyway, that's why. But if you look at the performance of General Beltings, it's a company which operates what can I say? Basically, two major business units, which is your chemicals and your rubber business. And much of its products, it sells them to your large, industrial companies. So it's a company that supplies, capital equipment and even spares to your large, mining houses and even manufacturing companies. So its performance actually is directly linked to the performance of the productive of the industrial sector, which is your mining and your manufacturing sector. So what happened in 2018? 2018 was the year when foreign currency shortages entrenched. And if you look at General Beltings, much of its products, your rubber and some of the chemicals, it imports from as far as Germany and some from South Africa. So the company, suffered in terms of key input supplies, but I think they reported that demand-wise, it remained, robust throughout the year. So they had, some challenges, in meeting that high demand because of foreign currency shortages as a result of, discontinued macroeconomic headwinds. But they went into a strategic partnership, I think, with a German supplier. So in 2018, they maintained, their revenue up there because the German supplier, happened, to give, to provide some of the key raw materials, despite General Beltings, failing to pay for those inputs in the required time frame. So if you look at that, what drove that PAT downwards was actually the increased finance cost, because when you continue to acquire more debt, it means that your debt servicing cost will go upwards, and they will eat into your profits. This is what
then could we expect from General Beltings going forward? Are we likely to see an improvement?
To me, like our projections, 2019 is not a very good year. It's a year where we are actually projecting that we'll be in a recession, where your manufacturing, your mining sector, and your agriculture sector, we actually project all those sectors to contract. So this is a company which is linked to those sectors. So if those sectors underperform, it means that General Beltings, will face serious headwinds. It now depends in terms of how they will react to those economic headwinds internally. But I think it's actually a challenging year for them, and performance might be worse than what they did in 2018.
Worse.
Yes.
Well, thank you, Tinashe. Thank you guys for watching. Please stay tuned. Up next is a focus on the stock market.
Good evening, ladies and gentlemen. Welcome to Markets Daily on Equity Access. Joining me here today is the Chief Analyst, Respect Benzi. How are you doing today, Respect?
Sure, I'm doing just great. Let's kick into the markets, see how markets played out today.
Well, the market today had a 50% jump in volumes, but 51% decline in the value to about $7.5 million traded today. 27 counters did exchange hands. Result of it is what we see here today. All shares up 0.78%, and the industrial index is up 0.76%.
That's quite a huge value of trade, 7.5 million in a single session. I think that's quite a jump from the market average lately. I think we've been trading an average of 3.5 to 3 thereabout.
Yes, about 3.5, 4 thereabout. Maybe a little bit closer to 4.5, but then it is a big jump from average.
But I think the trading dynamics are getting quite more interesting given what's happening elsewhere in the economy. Given what has been happening lately, especially on the interbank, I would expect volumes to start slowing down a bit. And of course, so I guess the jump there at the 7.5 million in value of trades is quite huge. And of course, the prices as well still going up by some huge margins. I would expect that to slow down in the next few days. What's your thoughts on that?
Well, there has been some telltale signs about a slowdown within the market as of late. It still is on a rally. With the stock markets, it may slow down basically because of what you said. Now, I think the thinking around that would be that investors would really want to see how the forex market is now going to play out, especially with volumes likely going to improve, and also with how the interbank rate. Yes. So volumes improving on the interbank market may actually cause for a slowdown and have some investors now have a play into the interbank market. So it may slow down the market. The increase may still be there, a rally may still continue, but then margins won't be as high or as we have been experiencing as of late.
Yeah, but the rate going to 4.6 there on the interbank, and we still see stocks trying to hold and even move a bit. I think on the outlook, obviously would expect stocks to possibly try to hold and study the market a bit, but generally flows might improve if that 500 million, which is expected to be offloaded on the interbank, comes to fruition. It's still doubted. The bankers in the market haven't really confirmed to say these flows are coming on board as of today. But I think in terms of the rate, most have adopted what has been the twinning rate. There's been a rate which has been playing out off the market where buyers and sellers would just meet and bankers would just transact on behalf of these two parties. And that rate has been upwards of it would be the interbank plus about a 15% thereabout. So you would find a rate which was possibly even closer to 4, but now the rate is at 4.6. Cash rate maybe even somewhat around that level as well. But I see today as well the parallel market rate is also still moving up, of which the real reasons behind one of the rationale of trying to push the price to that level was trying to have a rate between the parallel and the interbank which comes closer to each other. So I think those are some of the dynamics I think we should try to shape even stocks as we go, because we know that as value is lost in RTGS and bare balances, definitely people would want to rush into safe haven, which might include stocks. So definitely there's a clear relationship between those two variables, and it's important for us to keep on tracking in terms of how that affects the stock market. I think we can continue on.
Well, like I did mention, all share and industrials did notch up. Now these are the only two indices that are now in the positive on a year-to-date basis, up 0.82% and 0.53%. Mining's index did go up 1.69%. Both Bindura and Ryozim did add on to their share values. Top 20 index is up 0.73%. Well, we had about 4 counters on the top 20 index that were in the positive, vis-a-vis another 4 that are on the negative, and the rest being stable. Now, the all-share index on a 5-day trend, it is now up 2.6%, while the top 10 index is up to 2.83%, and the industrials index is mimicking what the all-share index is looking like. The mining's index only is up 1.69%, resulted to today's jump on its point value. Now, Ariston is leading the pack of 17 bulls versus about 9 bears actually that were on the stock exchange today. Lafarge was the leader of those bears today. RTG did trail Ariston, coming up 18.06%. For it to settle at 8.5 cents.
But if you had to look at the top counter by price gain, that's Ariston, I think some important fundamentals there. It's one of those companies which is underrated in a way. If you look at the business model, this is a company which sells close to 70% of its produce in foreign markets.
Yes.
Of course, agriculture is cyclical in Zim, but I think it's quite important to most of the companies that are now highly sought after on the stock market are those which are able to preserve value and those that are able to generate foreign currency in a market where the exchange rate has been weakening. And so Ariston is one of those counters that people really know less about in terms of the fundamentals. And they've been struggling all these years. And they emerged in the past year, and they're now strong back. The balance sheet is now strengthening as well. They're obviously trying to still push up the restructuring exercise, but in terms of the core performance at operating level, quite some solid performance. Good macadamia performance, good avocado performance, good tea performance, and even quite some fruit. Quite some wonders coming from Storm and Palm that's in the Nyanga fields. So I think this is a counter to really watch, and there's no doubt that it's one of those top performing counters on a year-to-date basis. And if you had to zoom in again on RTG, it's almost closing in on the bar, going up 18.06% today. Last week it was one of the biggest risers. It actually went up by 50%. And one of those key fundamentals, they earned a good fraction of their income from the foreign market in the past year. Tourism, of course, and most of those people who come from outside, in fact, they pay in forex, and so it has been one of the other counters which has got the ability to generate forex. And these are the counters where we are finding consolidation of share prices by investors.
Yeah, RTG did enjoy about $11 million of foreign business coming into their revenues.
Yes.
So it's a good counter to really look at, basing on those objectives in terms of trying to look for a counter that has value storage and also the ability to actually earn some foreign currency.
Yes, and again, Econet, the top valued counter by market cap, obviously closing up 8.67. It's still struggling, but it's been one of those counters which investors have highly been seeking or resorting to for purposes of hedging their positions. PNC, it's really struggling, but I think lately it has gained a bit of traction. I think there's still issues about low-grade ore and also the issues to do with high marketing costs, which is obviously dampening their net realized amounts from their sales. But I think it will be one of those counter which will be keen to watch in the current year. I think that they're just about to release their March results in a matter of a month or so. It will be interesting to see the dynamics around how they have performed, but they've been decrying low prices in terms of global obtaining nickel prices, in terms of restarting their smelter. So obviously that also reduces even what they get in terms of the revenue that they generate, because they presently get 75% of the net price which is prevailing on international markets from a third party whom they sell to. So they sell their produce via Glencore. So I think obviously those dynamics around prices on the global markets and obviously the quality of the ore that they're mining will be critical in terms of seeing how they perform in the March year. And the FCB, it's a company which is trying to emerge from a serious restructuring exercise after the acquisition of the former Barclays Bank by the FNB of Malawi, going up there 6.4%, but obviously shedding a lot of value in terms of non-interest income coming out of loss of transactional business. They had a serious downtime, and getting into the first quarter, it's still dampening income from non-income lines. But I think as we go forward, they might be able to recoup. They are getting about 1.3 thousand new customers every month, and of course they've been trying to reduce that rate lately. But I think it's also a counter that will be so keen to watch as well. Getting into the losers, Lafarge coming off 9.09%. Lafarge has been struggling. Obviously, that's why it's receiving that kind of battering lately. It's been much a function of increased competition. We saw the biggest player in the market, which is PPC, increasing capacity, getting closer to the market, eating into Lafarge's market share. Lafarge has had a lot of significant downtime within their production in the past year, so they have lost obviously volumes as well, and obviously the issues to do with the failure to import certain raw materials, and even some of the consumables and some of the parts that they need on their plant. But one of the key executives of the regional group came to Zim a few weeks ago, trying to institute some changes. We saw the new CE coming on board, but they also want to increase capacity, 450,000 metric tons of cement per annum. They want to increase that. If you look at how they are arranged in Zambia, they have capacity of over 1 million metric tons in two plants, one in Ndola and the other one in another region, and they've been doing good in that side. So Marsh coming off 8.48% to 3.3%. Of course, this is one of, most of all the property companies in 2018, they performed good, rental reviews and all that. But I think 2018 will be a new dynamic, slowdown in demand, and consumers trying to get the best value out of their money, so obviously trading down, so they'll be looking for cheaper accommodations and cheaper avenues of rentals. That is for those on the commercial side. But they have been trying to expand in a different route. They are now getting into hospitality, which is a new frontier, and you know that in partnership with another third player. So we definitely would love to see how the institution evolves.
Yes, it's very interesting that a lot of property companies have either ventured into tourism now or have strengthened their position within the tourism sector. I like to think that they would only start realizing meaningful returns maybe in 2020, 2021. 2019 may be a difficult year for them to regain a lot of, to maintain most of the revenues that they did get last year. Last year was a lot of issues to do with how elections were playing a part in terms of bringing in a lot of tourists within the country. Other factors did come into play, but then now into 2019 going forward, with how things have been playing out within the economy, tourism numbers may be coming off. 2020 may be a difficult year, but then it may come back up again depending on how the economy is.
I think when it comes to tourism, this is a long-term game. We have to look at. Our natural resources are never going anywhere. When the country stabilizes and there's proper macroeconomic stability, we are definitely going to see a booming sector. But we have to realign, obviously, our costs, increase space in Vic Falls. The number of rooms there really have to improve, but there's a strong demand, and we really have to push that hub as a special economic zone to really realize our full value. So I think for most property companies, it's an area to watch. Residential as well. There's been a serious backlog in terms of residential housing properties in Zim. I think about 1.something million in terms of a housing backlog. And Marsh is it's in terms of its portfolio, they don't have as much exposure in that side, and it would really push their numbers well if they also start to concentrate on that side of things.
I agree with you in terms of residential. I think also student accommodation is something that they should really look at. If you look at our demographics within the nation, we have a very wide base, and that means a lot of college students are going to be coming into a lot of colleges. That means a high intake in terms of colleges, where most colleges never have enough accommodation for all of their students. So that number should be going up. But then colleges still do face the threat of a bad economy that is causing for some students to become dropouts and the like. So property industry may be something to be really looking into going forward. TSL up 7.69%.
It's actually down.
Down.
6.9. I think it's this is an agro-industrial firm with a significant exposure in tobacco, and tobacco has not been a good season. It's not seen a good season to date. The numbers are looking very low in terms of value of trades. It's down by over 50%. Volumes are down close to between 20 and 25%. And those are huge numbers. There are issues to do with the value, the prices on the floors, and also the quality of the tobacco and so on. So these dynamics are not going to play out good for TSL, which has got a significant exposure. They provide storages, they also provide packaging through Propack. And so on the TSF side, they do have the floors, and they also do storage as well. So they are in the value chain, the tobacco value chain. That's where they get significant amount of their money. They also play in some other number of crops. Within what Zimbabwe grows. So obviously, a bad season affects their net realizable earnings. Old Mutual and FML insurance companies. Keeping the set. Of course, Old Mutual does that may be. This is a dual listed firm. Lately, there's been some good demand for the counter. It might just be cooling off as people take profits, or you could say quite a number of foreign investors have been holding the counter, and around the dynamics to do with the recent expected flows on the interbank market. Maybe people are starting to push their monies out into
because it did extend on its losses. Yesterday it was also down again, and today it did extend that loss.
Sure. Let's move on to the much expected on the interbank side of things. We are seeing quite a jump there, a real jump, which is the highest price so far since the consummation of the interbank, which is around February 2020, yeah, thereabout. The market closing there at 4.62. What's your take?
Well, there has been much talk around how the government has fully liberalized that market now, especially much to do with oil companies, where fuel providers or fuel tenders actually were getting what you call it foreign currency at 1:1 prior to their statement.
Yeah, I think it was a matter of arbitrage where you are providing a retailer or a distributor with 1:1. You're giving them money, you're giving them fuel on 1:1, and they are going out there and they're selling at higher margins, either in USD or even in higher price on the local figure. So they're trying to close that gap. But essentially, I think this move is designed to curb excesses on the interbank market, because there were no flows on the interbank market, and government wanted to control the rate. Why? Because they are also taking something from miners and whatnot. So they're trying to suppress the official rate, and they're also trying to suppress the official rate so that they won't be paying as much as well. Why? Because they needed certain money which they could also be giving to certain side of the business, like fuel side and other people who are relying on letters of credit on a 1:1 basis. So by fully liberalizing it simply subjects every other variable to the market dynamics as well. So it's a welcome development, but obviously there's bound to be a serious shock in the economy. But I think what could have been fundamental is to ensure that within our budget levels, or within what we had promised to say, this is going to be our macro framework. We are going to stabilize our revenues to our costs. We can be able to maintain that. But I don't see that in the current market. And this is one point where people definitely tend to lose confidence in the market. If you're failing to stabilize your fiscal side, then obviously it will be difficult for people to trust that your currency can stabilize against the USD. I think that's one of the challenges that we have. So it remains to be seen where the rate goes from here, but the sentiment in the market is not as good. But either way, the market had to liberalize. We had to start over again, but government doesn't have to manipulate, and they have to be honest, and they have to close every gap of arbitrage in the market in order for the interbank market to work.
Okay, that's fine. I think just to close off the show, parallel market has now firmed itself at 5.7. Yesterday it was about 5.68. Today is at 5.7. The old mutual implied rate is.
So what is likely to happen on the parallel market? Are we still likely to maintain that huge jump? Because if you start having flows here, it means the demand which was going to this end will start coming off too. So if it's sincere that flows are going to improve on the interbank market, then there might be a bit of a convergence, because the people who are buying here are people who are I'm not looking at 100% convergence. Obviously, you have to leave a bit of a margin for players who can't access money either way on the interbank, but there has to be like a 10 to 15% margin, but not as wide as this.
No, the margin is going to slim down. I'd like to also suggest and think so. Maybe the margin may come off to maybe a 0.7 difference, with the interbank coming up to about 5.2 thereabout. I wouldn't know how much of a prediction I can put in without the assurance of the $500 million coming in. Well, that's it from me, and respect and the Equity Access team. Please do not forget to like, follow, and subscribe our YouTube, Twitter, and Facebook channels, which are at Equity Access. Good evening.